In today's video, I'm going to cover one of the key markets where I sell and offer services, and probably that is something most of us have heard of, but we never understood what does mean, and that's what I'm going to cover. It is basically the capital markets in the United States, what it meant, and what are the types of the companies in these areas, and what are the and based upon that you can evaluate whether those make sense for you to pursue any career or offer solutions or start a company and things like that. But today I will cover the basics. Hey guys, welcome to Money Mindset and More. And today I'm going to cover what is the capital markets in a very simple terms. I will try to explain them, and what are the companies which operate in this particular market. In a very simple terms, capital market is something where individuals, institutions, or governments raise capital to either, let's say, fund public projects as far as government is concerned, or expand their companies when it comes to cooperation, and also startups if they want to fund their companies from different sources. And how it happens, normally these companies or government issues securities means it might be it just think like something as a security. Let's say you have a gold, you want to borrow money against that, but in place of gold in this scenario you have a security means either a stock which will be a part of the business, or a bond which is nothing but a legal agreement between the investors and the person who is raising funds, that they will pay some money as interest over time. Now capital means basically nothing but funding. In very layman terms, somebody is raising money to either expand their business or start their business, or in case of government they are raising money to build certain public projects and things like that. Now there are two types of markets. One is security markets, another one is debt markets. In securities markets, uh, not securities, I would say equity markets. In the equity market, you basically issue shares of your companies. Basically, you are doing dilution of your ownership, and somebody is buying those ownerships as an investor in the view of, let's say, more profits and more valuation in the future. That is the equity market. Then you have the debt market, where you are not dilution of there is no dilution of your ownership. You're basically raising money as a debt, and the person who is investing is basically borrowing money at a certain interest rate, and based upon that investors will get a promise of interest paid in the future. Very classic example is US government treasury bonds. Because of the stability of US economy and US government, treasury bonds of US government are supposed to be the safest investment in the world as far as today's market is concerned. And so these two are the major types. Now there are two specific markets also where all these securities normally trade. One is primary market. The primary market is simply where somebody is offering an initial public offer of their stocks or bonds and things like that. That is called initial public offering, and then they can also have a follow-up public offering which we called FPO. So those two can be your primary markets. Then secondary market is basically where we all buy and sell stocks as a retail investors. Classic examples are New York Stock Exchange and NASDAQ and all those things, where all the security trades, and then obviously we buy or sell based upon whether what we feel from the market. Most of the time people buy from emotions, but if you do all the analysis, you might be buying or selling based upon your analysis, not the sentiments in the market. So primary and secondary markets. Now there are multiple types of companies operate in the market, and they vary from different things which they do. I'll cover some of those, in starting with your financial institution, which can be categorized into investment banks, which are actually into issuance of security, underwriting securities and things like that. Those will be In US, they will be Morgan Stanley or Goldman Sachs, somebody like that. Then you have commercial banks like JP Morgan Chase, and they normally issue loans, facilitates different kind of securities and bonds and things like that. And they are also one of the biggest one in United States. Probably JP Morgan is the first company which has the integrated offering in all segments of retail banking as well as capital markets. Then comes your central banks, which normally guides the rates and things like that, and oversight for money supply. That is something which is normally done by Fed. So in US it will be Federal Reserve, in Europe it will be European Union Bank and things like that. The next one is your stock exchanges, where you buy or sell securities. So it can be a simple stock exchange like NYSE or NASDAQ, and then obviously you have individual trading these days, electronic trading systems like E-Trade and others, which ultimately connects to the stock markets. People think it's real time, but they are actually connecting to the market and within a fraction of seconds. They are not live, I would say, but they are as live as for a retail investors. Then you have asset management companies and investment firms. So asset management companies are normally mutual funds, where these companies, what they do, they buy stocks in all companies and they diversify. So they collect the money from the investors, then they buy securities in a diversified way. So for example, let's say S&P 500, something like that, and they invest in those things. So they are diversified in all the companies rather than putting all the money in a single security. And then you have hedge funds. So hedge funds are very high-end investments, not open for most of the people, but they are looking for complex strategies to make higher return for their investors. Classic examples are Bridgewater Associates, Citadel in US. Mutual fund can be Fidelity, Vanguard, and all those companies who are offering those solutions. The next one is brokerage firms who are trying to facilitate all these trades. So there are full service brokerage firms like Merrill Lynch, Charles Schwab, who are offering all kind of brokerage services. And then you have discounted services, which are like probably a little bit cheaper and but limited options, and they can be accessible by retail investors also, like TD Ameritrade and Fidelity. Those are also brokerage firms. So you must have some accounts with either of these companies if you are buying or selling stocks. But TD Ameritrade, Fidelity, or E-Trade, most of the people might have between these three. Then you have credit rating agencies, which normally give the rating to the bonds and securities and countries and things like that. In case of US, it is Moody's, S&P Global, and others. A very important factor when it comes to doing the ratings for all these bonds and securities in the market. If they go wrong, they might go wrong. If you have seen 2008 crisis, they have been wrong, but they are essential, what you call, pillar of this capital market structure. Then you have companies who are market makers and high frequency trading. So high frequency trading are those companies who are trading in a very high frequency, low latency trades, and they mostly play in equity market. So for example, within even a fraction of seconds, they might be trading securities between New York Stock Exchange and let's say Chicago Stock Exchange and things like that. Very highly complex, very few people do it. And companies like, I think Jump Trading is one of the companies which is in the business. And then I think Tower Research Company or something like that. There is another high frequency trading company which I have heard of. I have never dealt with them. And then you have market makers who are ensuring the smooth trade between buyers and sellers, companies like Citadel, Virtus Financial, and things like that. So, and they are probably have a larger impact because they normally, in my experience, they normally expand the elasticity in the economy by making a lot of markets for people, which are not open for retail investors for sure, but they do all those things for capital markets. And the last one is, while most people don't understand that, insurance companies and pension funds, they are probably one of the biggest investors in capital market space. Insurance companies have a lot of premium comes in and they don't know what to do. Most of the time they normally go and invest in equity markets or in a hedge fund or something like mortgage backed securities and things like that. But they normally invest in capital market because that's where they get higher return, and in turn they can make money and give to their investors, or in case of disaster they can sell for higher price and things like that. And then the pension funds, so pension funds collect monies from all the employees and, let's say, individuals. That money is, again, they are promising certain percentage of return to their investors, so they need to earn more than that to make sure that they cover their costs and have profitable. And that's what they do by investing in capital markets. Most people don't understand that, but you have to be very careful when you are buying insurance or you are investing in a pension fund. You need to understand what they do with the money. They normally disclose everything as per the law, but most of us don't read anything. They give you like a booklet, nobody reads it. But yeah, so these are the companies I will be probably covering more in detail. This is a topic which I normally offer services and consulting in my corporate job, and it's very lucrative field to go in. Most of the people don't know until they settle for, let's say, computer science or something like that. But this is the area where you can actually make a good career and earn a lot of money if you want to. Let me know what's your thought, and if you have any question, please post in your comments, and like, share, and subscribe. Thank you very much. Take care.